Welcome to Stock Informer for You. The noise in the market is loud, but we prefer to let the data do the talking. Earnings season is officially here, and the market is already throwing some major curveballs. Tomorrow, July 9th, the IT bellwether TCS drops its highly anticipated Q1 FY27 results. Meanwhile, retail giant DMart just released its provisional revenue updates, and despite a 15% jump, the stock slipped 5% to the 4,030 rupees zone. What is going on behind the scenes? Are these corrections a warning sign of a structural slowdown? Or are they presenting an elite buying opportunity for smart investors? In today's video, we are diving deep into the raw numbers, the secret impact of artificial intelligence on IT billing, and why DMart is breaking its legendary zero debt rule. If you're trading or holding these stocks, grab a notebook. You cannot afford to miss this. Let's get into it. TCS Q1. Estimates, currency versus real growth. Let's start with Tata Consultancy Services. Tomorrow afternoon, TCS kicks off the IT sector's earnings print. The consensus among the big brokerages is predicting a relatively flat seasonal quarter. Headline rupee revenue is expected to land around 71,743 crore rupees, which looks like a modest 1.5% sequential growth from last quarter. But here is the first hidden insight. Constant currency growth is modeled at near zero, just 0% to 0.4%. This means that small revenue bump isn't coming from new volume or client expansion. It's almost entirely a pass-through of the depreciating rupee against the US dollar. Real core execution has temporarily flatlined. Worse, operating margins are expected to compress by 100 to 120 basis points, sliding from 25.3% down to roughly 24.1%. Why? Because TCS absorbed its annual wage hikes on April 1st. If the margin print drops below 23.9% tomorrow, expect some serious heat in the markets on Friday morning. The two-edged AI sword in IT earnings. But numbers only tell half the story. The biggest structural wildcard for TCS tomorrow is artificial intelligence. TCS boasts a massive annualized AI and GenAI pipeline, tracking near $2.5 billion. On one hand, this is keeping their order book steady. But on the other hand, the street is terrified of a phenomenon known as AI deflation. Think about it. Historically, IT companies made their highest margins billing by the hour for linear maintenance and coding. Now, developers using GenAI code assistants can complete those tasks 30% faster. Corporate clients know this. During contract renewals, clients are demanding 20% to 30% price cuts, arguing they won't pay legacy hourly rates for work an AI agent is assisting with. Tomorrow at 7 p.m. IST, during the management call, don't just look at the deal pipeline. Look at the headcount changes. If revenue edges up while employee count drops, it proves TCS is successfully pocketing AI productivity gains. At a trailing PE of just 14.4 times after a steep year-to-date correction, a lot of bad news is already baked into TCS's price. DMart's 15% growth and the quick commerce threat. Now, let's switch gears to retail. Avenue Supermarts, or DMart, released its provisional Q1 revenue update, posting a solid 15.1% year-on-year jump to 18,343 crore rupees. So why did the stock slide 5%? Two reasons. First, in Q4, DMart went on an absolute blitz, opening 58 new stores in 90 days. New stores take over a year to hit maximum operational density. Right now, those young stores are diluting the revenue per store metric, pulling same-store sales growth down. Second, the elephant in the room, quick commerce. Platforms like Blinkit, Zepto, and Instamart are aggressively changing urban midweek buying behavior in metro areas. While DMart remains the undisputed king of cheap monthly bulk groceries, its metro footfalls are facing friction. DMart's shocking fundraising blueprint. To fight back, DMart is doing something completely uncharacteristic. This Saturday, July 11th, the board is meeting to approve a massive fundraise through debt securities via private placements. For years, founder Radhakishan Damani ran a strict zero-debt business, buying store land entirely out of pocket. So why switch to debt now? Because commercial real estate in India is hyperinflating. If DMart waits to accumulate cash before buying land, it loses the race to expand into North and East India. Just days ago, on July 6th, they quietly issued 300 crore rupees in commercial papers at a very cheap 6.60% interest rate. They are using low-interest institutional debt to lock down land banks and scale up DMart-ready infrastructure before competitors can catch up. Even at an expensive 88 times trailing PE, this capital leverage play could structurally expand DMart's long-term equity value without diluting a single share. Bottom line, TCS is a defensive value play trading at an attractive multiple with a 3% dividend cushion waiting for a tech spending thaw. DMart, on the other hand, is aggressively shifting into a hyper-growth land grabber to protect its retail throne. Which of these two structural stories do you find more compelling? Are you buying the DMart dip or waiting for TCS's margin data tomorrow? Let me know in the comments below. Don't forget to smash that like button. Subscribe for the full earnings breakdown this weekend, and I'll see you in the next video.